Hey everyone, welcome back to the channel. I got Jay Pestricelli back on the channel, who is now the Chief Investment Officer at Tidal. How are you, Jay?
Doing great. Great to be back. Thanks so much.
Yeah, it's always good to have you. Definitely a popular guest. And today we're going to talk about the new zero DTE ETFs from YieldMax. So you guys have the trifecta, right? You now have the S&P, the Nasdaq, and the very recent one that just came out just a couple of days ago, the Russell 2001, right? So we're talking about SDTY, QDTY, and RDTY. These are all daily zero DTE covered call ETF. So tell me about them. What is the strategy behind these ETFs?
Yeah, these are really index focused ETFs, as you mentioned, the three indexes that we typically trade. They are kind of true zero DTE products where we are trading, entering positions on the day of expiration, right? So we'll enter a position in the morning that expires that afternoon or that evening. Yeah, this is really kind of more of a growth focused product, just meant to capitalize on the volatility in the market each and every day. We happen to be in a period of a little more elevated volatility right now. Market's been a little dicey. So, look, there's times where that's going to generate a little more income or you capture a little more upside growth if the market was to go up. Whereas in periods of lower volatility, the premium that we're going to generate by selling zero-day options might be a little less. So the general gist is we are essentially long the market always,
Yeah.
long the index, not really leveraged at all, just, generally just long the market. And then in the morning, selling an out of the money call that is going to bring in some premium. And the goal here is to be able to capture some growth, even the overnight growth. I know that's a question you've asked other guests in the past, but even kind of capture overnight growth. And then along with that, some additional premium from selling calls.
Yeah.
So that's the look. We do a lot of call selling at YieldMax, as you know, of all people,
Yes.
and now this one kind of brings it to the index to being, very, very near term, being just selling same day options.
Okay. Pretty simple enough, right? Based on the index, daily, overnight exposure, right? And this is uses, correct me if I'm wrong. I'm looking at the holdings. It looks to me like a just like the other yield max, a synthetic strategy as well, right?
Yeah, in this
So,
case, you're right. We're along the index by using the deep in the money call. So actually, the very first line there, right, that long SPX 1000 call, that's just that's it right there, right? That just gives you exposure to the market without really any time decay, right? You go
hmm?
deep in the money, like that thousand strike, while the market's trading what 5,800, 5,700 today. So those are deep, 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 deep in the money. So there's really no time decay on those, and those essentially what we would call them 100 deltas, meaning they'll move one for one with the market throughout the day. That's exactly right.
Yeah, I do sometimes keep getting questions from people who are worried about, you're not actually holding the S&P 500, you're doing it significantly, sorry, synthetically. But you just said it yourself. Yes, it's synthetic, but it's delta, it's one for one. Whatever the S&P does, you're capturing the same thing. So essentially, in my opinion, I don't know if this is technically right, but it's basically like you're holding the actual index itself.
Yeah, it's going to replicate the exact index exposure. That's correct. That's the intention of this. In this case, we call this a synthetic exposure, just using a long call. In other YieldMax products, I think we do the long call and the short put closer to the money. But with the indexes, we don't need to do that. We could just buy the deep in the money call to get that 100% exposure.
Interesting. Okay,
Yeah.
and then there's some in the I'm assuming short-term government treasuries, which basically is the advantage of doing the synthetic, because you could put your cash and get a bit of interest as well, right?
Yeah, that's right. So about a sixth of the portfolio is in cash-like vehicles like
Okay.
the short-term treasury notes and bills that you see here, right? So the fund in this case, I don't think they have the total fund value, but fund at about, let's call it, 8 million and seven and a half, or maybe it's eight and a half. Seven and a half is in the long calls, and then the rest of it is in these it's just in treasuries to get a little interest while we're kind of waiting. Because you didn't spend 100% of your money, you might as well put it in, kind of short-term treasuries just to
Put it
earn a
in
little.
something. Yeah, yeah,
Yeah,
for
yeah,
sure.
yeah. It's
Okay.
not a big driver of the strategy, but it's, using using the cash effectively. That's it.
Okay, and all three do seek to pay out weekly, I believe, right? Weekly
That's a
distributions.
good point. These have weekly distributions
Okay.
based off of a few factors, but generally, the more volatile the market will probably distribute a little more because we're capturing a little more income. But really, Adrian, these are more growth-oriented products than they are income-oriented. I mean, I think the funds are still kicking out somewhere in the range of, between 20 to 25% on an annualized basis. So it's still a healthy distribution rate. But these are probably more aligned with growth than they are, just straight up yield max, which is really always about yield max. And I think um,
Yeah.
yield max has had a few that are targets, right? We have some target 12s out there, but these are really more focused on kind of how much growth are we going to capture? Growth is an important function of this particular strategy.
Okay, and
Yeah.
I'm just curious about so here are the distributions, and I was correct me if I'm wrong. If there's more volatility in the market, I'm wondering this is just a slight decrease for SDTY, but then you have QDTY, which the distribution was much lower than the last one. So isn't when there's volatility, shouldn't the distributions go up instead of down?
Yeah, so that you're 100% right about that. That's our intention. There's a few other functions that come into play. We had a 4 week period in there,
All
right?
right, right.
A 4 day week versus a 5 day week. There is growth in the funds sometimes, right? And so, while you're distributing, you might have assets that are flowing in. You didn't earn the whole time on those assets. So I think early on, this is still fairly early, right? In the fund's life, right? I think SDTY has only been live for a month, QDTY about half that, and as you said, RDTY just live a few days at this point.
Yeah.
So I think you'll start to see a little more tie to the amount of volatility that's going on in the market when it comes to these. But again, early on, we wanted to still make sure we were creating that track record of having the weekly distribution, so everybody kind of knew generally what to expect.
Okay, yeah, that makes perfect. I completely forgot about the shorter
There's
week.
a like short week in there, and sometimes there's a little delay in the way that you
Yeah.
calculate the dividends and that kind of
Okay, and
stuff.
for the record,
Yeah,
even the Roundhill one also a big reduction, which brings me to my next question, which I know everyone's going to have. How do these compare with the Roundhill ones, which seem to have a very similar strategy from what I could see, right? Synthetic with the overnight effect. What would you say is the main difference?
the main difference is we are active throughout the day on these funds versus just sell the call and be done.
Oh,
We
okay.
will make some modifications throughout the day. So yes, we'll put on our trade right at the open. Market opens, we'll sell our call, whatever strike we're going to use. But if you have the opportunity throughout the day to kind of cover buy and sell again to maybe increase your income or raise your limit of upside potential capture, we're going to do that. So you're going to get to see, YieldMax is always a little more active than our peers in the marketplace, and I would say that absolutely applies here to the Roundhill funds too, where we're going to be more active throughout the day and make adjustments.
Super interesting. I kind of like that. So you could possibly get more premium. So let me just go through a typical day because
Sure.
I'm a pretty new person when it comes to options and stuff. So let's say it's the morning, you're writing your call, the market goes up and you hit your price. Are you saying let's roll it, let's write another that expires before end of the day to get more premium?
Yeah, so or in that scenario to unlock more upside capture, right? So in your example, let's say we sold a call that was 0.5% out of the money,
Yeah.
and now the market is up 0.5% or 0.75%. Well, we're going to look at that and say, look, we'd like to kind of capture more upside. We'll cover buy back the one we had that obviously has some cost to it, and then sell another one to again unlock a little bit more upside so we can capture again more growth. Again, the focus on these is income, but really growth is I'd say the differentiator on these funds. And then vice versa on a down market move, right? You'll earn your premium fairly quickly, right? We
Yeah.
sold again 0.5% of the money. Let's say the market's down 0.5%. We could cover buy back that option for, notably less than what we got paid for it. So you buy it back, you sell another one to generate a little more income in the markets. By the way, sometimes that's at a different strike, a little higher strike, sometimes a lower strike. I guess it'll all depend time of day, volatility in the market at the time. But yeah, so that's exactly right. We are going to be fairly active throughout the day on this strategy, not just to set it and forget it in the morning.
Okay, interesting. And would you say that the calls are always written out of the money so you ensure you're capturing the upside of the market?
Yes, yes. I can't think of a scenario where we'd sell a call that's in the money. But even if we did, there would have to be a tremendous amount of income that you would do that for. You do that to create a little bit of a buffer, but that is not the approach here. We're always trying to sell. The intention, we're always going to sell out of the money to capture some upside, regardless of what's going on in the market. Yep.
Okay, interesting.
Yeah.
And how would you say these compare to the Defiance daily, who I
Ah,
believe are the original OGs of the daily? So I'm talking about QQQY,
yeah.
JPY would turned into WDTE, and there's also the Russell one as well.
Yep,
So
IWMY is the other one. Yeah.
yeah,
So those sell puts the night before. They sell out of the money. They sell in the money puts, which are above the market. Those are more focused on income. So actually, when you look at a market environment like we have right now, where the market is sideways, income focused may be a better
yeah,
approach with a sideways market, right? The market has definitely showed some signs of weakness over the last couple weeks. So in those scenarios, maybe an income focus could be, it could have some outperformance. But quite frankly, it is a different tactic. Those are more focused on income versus growth, whereas the SDTY, QDTY, or DTY that are the YieldMax 0 days, those have more focus on growth with some income, whereas Defiance is more focused on income over growth.
income capturing, right? Because you're the way I see it, I like to explain it. Look, if you're seeing higher yield and less growth during an up market, it means they're doing more calls. You're not capturing as much upside, but you're getting more premium. That strategy works really well when the market's flat or down like it is now because you're cushioning, you have more cushion to your downside.
Yeah, I mean
That's
that's
how
the
I
point
see it.
of grabbing that overnight volatility. So the zero DTEs, the yield maxes, miss on the overnight volatility because especially right now, there's plenty of option premium just considering from 4:30 to 4 o'clock to 9:30 in the morning. There's the chance for the market to move dramatically. So there's an additional amount of premium in the options at 4 o'clock at night for the next day versus say the 9:30 of the same day. So yeah, it's more focused on the income side than the growth side, which the
Fair
yield
enough.
maxes are more growth.
Okay, fair enough.
Yep, yep.
Last question before we take one or two from members is, will these three be added to the all-in-one yield max, which is YMAX, or the ULTY one?
Yeah, the answer right now, the answer is no. That could change in the future. Those are more of the single stock covered call strategies like the Teslas, Nvidias, Conys, and Misties of the world. Those land in YMAX. Here, these are more index based and multi. I'd almost say more. Like it's not a multi position strategy because it's one index, but it's an index that has 500 or 100 or 2,000 stocks in it, which is why like ULTY, for example, is not included in YMAX either, right?
Oh, right, yeah.
So these probably will not be included in those fund of funds.
Okay, makes
Yeah.
sense. So we got a question from Andrew Walker, and it's a pretty good question. I would like Jay's comments on the rise of income investment products. Why does he think they're becoming more popular? And does he foresee any regulatory risks on the horizon for this segment of the investment industry? Pretty good question. Your thoughts?
Yeah. Yeah, look, I think I mean, Adrian, you could answer the what's the popularity of the income funds, right, yourself. But I would look, I think that the uniqueness and kind of I think there's a little bit of kind of groundbreaking or change of opportunity when you look at ETFs like these that have the significantly higher distribution rates than say your standard JEPIs or QYLDs that have been around for quite a while.
Yeah.
I think the popularity here is due to utility, right? They are a tool to be used in an investor's toolbox as they want, whether you want to have money come out, you want to reinvest the dividends, you want to use it as a distribution tool across multiple positions. Like you have a lot more use cases with these, significantly higher distribution rates that we see in like a Tesla or an Nvidia or even YMAX, right? With a 35-40% distribution rate, it allows you to do a lot of other things in your portfolio. So I think it's because literally they give you options, right? But options on how you invest within your portfolio, because now you could choose what you're going to want to do with these things, right? It's one of the reasons why we always distribute every penny we sell in premium out
I
to
like
investors,
that.
because we
Yeah.
want, hey, you choose what you want to do with it. If you want, appreciation and growth, great, then you can reinvest right back in the fund. If you want to use that cash or use that income to turn around and rebalance, or even just take money out, which I think a lot of folks like to take cash out, or let it sit in cash when that happens. Great. So I think it's the utility that's always been popular here with YieldMax. Now, look, you look at some of the older funds that have been out for a while, they were already growing in popularity, right? There were billions and billions in JEPI before YieldMax even, ever came to fruition. So I think it's just, the kind of the next level of evolution that we think we've tapped into with YieldMax. But quite frankly, income's always has some level of popularity, right? When you started your channel, you must have thought it was interesting to the world, right? Which has kind of got you going a little bit.
Yeah, I had no
Um,
idea it would this style of investing will get super popular. As far as I know, I was the only one going all in on in covered call. Income is not new, but really from
the
the covered
covered
calls,
call,
a bit
yeah, the
newer
option based.
concept up with options, which now we have daily. It's gotten more understood and accepted as well. But yeah, I think the big word I like to use, and which you described perfectly, flexibility, right? You do what you want with your monthly or even weekly income. You want to
Yeah.
reinvest it because you're a growth investor, you just want to reinvest and you're growing your capital with more units, or you invest in something else, or you go on a vacation, you reinvest half of it. So I think flexibility is a huge thing a huge advantage with this style of investing. So
Yep. And then to address the regulatory question,
yeah.
look, there's always, potential change in regulation. That's something we're always looking out for. There's nothing on the immediate horizon that we've seen when it comes to the derivative-based ETFs, right? There's nothing pending, nothing that there's been comment on that we need to anticipate. But, there's always a chance. I would say that we're probably in, a term here in the US where we'll have less regulation, right? And application of restriction. But I'm going to tell you, regulation is not necessarily a bad thing. It's what allowed us to create these types of ETFs in the first place, right? So, an advanced regulation can be helpful as well. But, right now, look, I think it's a really smart question. It's something that we ask ourselves all the time. What could be, what's coming around the corner here when it comes to regulators. But so far, these have, we continue to file, we continue to comment. I will say this. Our filings got a lot more questions and a lot more commentary and dialogue back and forth with the SEC now when we file, but still everything still seems to be, well within the guidelines. So far, nothing, immediately on the horizon that's making us nervous.
Good. All right. Yeah. Well, that's good. The other question has to do with how they compare with the Roundhill ones. So I think we've covered that in detail, right? So
Yep. No, and I appreciate us talking about these only because these are fairly new and they're new for YieldMax to be really doing that zero DTE trades. So, let's see how the adoption goes within the marketplace. We've seen some initial, positive momentum out of the gate and adoption. So we'll hope that it continues. And again, like I said, more focus on growth with the yield. But we really wanted to capitalize on the, zero DTE phenomenon that's, continues to grow, right? More and more transactions happen in zero DTE options every single day.
well, that's good. The volume goes higher as well, which is
Yeah,
good. So
volume's
yeah,
strong for sure.
I like the strategy. I mean, resetting that covered call daily to me is very interesting. We don't have any on the Canadian side yet. So this is really something on the US side exclusively right now. I think it's a really cool idea. And I'm glad you talked about, these are really a little bit more for growth. Yes, you get your distribution, but I tell people all the time, if you turn your drip on, that's growth. I mean, you're trying to
Absolutely.
grow your capital, and I would see these as a replacement to holding the actual index themselves, like a Vanguard or a BlackRock. You turn the drip on. It's kind of a replacement where you're kind of a little bit more calm and happy during a flat or volatile market because you're getting that compounding effect. You're seeing that premium and your units are growing, whereas when you're making 1% yield or less, you're kind of, the way I like to describe it, you're more dependent on one, the market going up, and number two, actually selling your units. With these, you could turn the drip on, you could reinvest it. There's just more flexibility, and I feel like you're less dependent on what the market does. And if the market goes flat or down, you're certainly less at risk to panic sell because, well, I'm getting paid every Friday. So, and now I'm going to get more and I'm buying cheaper shares. So to me, it's like a lot of psychological advantages with this kind of style.
Yeah, no, you've always had a great handle on that concept, right? Which is, compound your shares if you want to have the growth. That makes a lot of sense. I do think you touched on an interesting point, which I probably neglected to touch on. The risk with these is just the risk of the index, right?
Yeah.
There's no leverage risk here. Listen, you could make an argument that the premium we generate slightly offsets a little
Yes.
bit of the risk, right? But I would never say these are hedged. But I do say that, look, we are selling some option premium here that in a down market should provide some offset. And look, if we do our job right on these with focused on growth, we have, we're setting ourselves up for the opportunity to have some outperformance against the underlying versus, let's say, standard YieldMax strategies. You're gonna get capped from time to time in the Teslas and the Nvidias of the world. Whereas with these, if the reason we want to be active is to continue to unlock upside capture in a really bullish day, or to offset a little bit of the loss in a bearish day. So if we do our job right, we should be able to perform at or better than the index. You never know, but and that's not a promise, but it's just that's really what we're shooting for.
Yeah, it's still one of the most common questions I get. What are the risks? What are the risks of a covered call ETF? And I tell people all the time, the risk is the underlying asset. So it's
That's exactly
exactly
right.
what you said. What is the risk of SDTY? Well, it's the S&P 500. That's the risk. So what do you think the risk is of the S&P 500? So I always try to tell people, like, you got to look beyond the ticker. You got to look at the asset inside. What's the risk of the Tesla one from YieldMax? Well, it's Tesla
It's
stock,
Tesla
right?
stock. Right, right.
But like you said, that premium does hedge or a little bit lowers your risk a little bit in a flatter down market. But of course, the trade-off is there's a cap on the
Tap on
upside.
the
So
upside. That's exactly right.
yeah,
That's right.
that's
And
why.
hopefully with the idea behind going with the lower time to expiration, the same day expiration, like shrinking that in should reduce the amount of times that you hit that cap,
Yeah,
right? So,
exactly. Because like,
yeah.
for example, the QYLD or the ones that do a month, if they write one call every month, well, what if you write your call and then for the next 30 days you have an up market, up market, up market? You're missing a lot of upside, right? If you get
Right.
that timing, the call timing risk. So this is something that, which is why I really like weekly and daily because you're shrinking that timing risk as well. So hopefully people understand that. But like with explaining covered calls, I think with time I get better at explaining stuff because I'm learning myself as well, and having guys like you on certainly makes it easier. So Jay, I
Well,
really
you're pretty
appreciate
far
it, man.
along. Look, we all learn every day, but you're pretty good at it at this point, Adrian, right? So
Yeah, I
appreciate
mean,
it.
I'm kind of specialized in it, but I'm you got to be open-minded, and I will never know and understand everything. If you have that attitude, I think it's a good attitude to have as an investor. And this is why I love having you on. I'm sure this is going to be definitely not the last time. And I really appreciate your time, Jay, as always.
Yeah, it was great being on. Thanks for the chance to talk about these.
All
Thanks so
right.
much, Adrian.
Talk soon, my friend. Have a good
Got it.
weekend, by the way.
Thank you. You too.